Hi, welcome back to our second week of property management. I hope everybody is settling in nicely and they don't have any issues with the book or the assignments. This week, chapter 2 is all about real estate economics, and it's one of my favorite subjects because the economic principles are definitely guiding principles that we all live by, and a lot of theories that ring true in business formats when we put them to the test. So I personally really enjoy real estate economics, and I hope you will too. Sitting here in the property that I have currently for rent, it is located in La Mesa, and I want you to think a little bit about what the market is doing right now. Is it a strong rental market? Is it a strong buying and selling market? Do we have a lot of interest in rentals? Do we have a lot of interest in buying and selling? What time of the year is it? What are the demographics out there looking for? Is it easy to buy in the neighborhood right now? Is it difficult? Are there a lot of obstacles? How is the consumer confidence in the market now? Do we have a lot of confidence? Is it a soft market? Is it a buyer's market, a seller's market? What do you think? Well, I can tell you one thing though. The real estate market in general is always based off of the economic principle of supply and demand. And that's the basic principle that allows everybody to rule as a guiding principle of business. If you have a high demand for a certain product, then obviously you have to have a supply level that meets that demand. Otherwise, what's going to happen to those particular items if you're not meeting demand? The price is going to increase. And what happens if you have a lot of supply but not a lot of demand? Well, the individual unit price will decrease. So it's an inverse relationship with each other. In real estate, we talk about any type of investment fund, and as a property manager standpoint, what does it mean by an investment? What are we investing in? Well, any type of an investment is an allocation of funds, of your personal funds or a company's funds or a family's funds, doesn't matter, to generate a profit. And you're trying to get the best return you can either on real estate, on stocks, bonds, certificates, commodities, any of those things. You're looking at what do you have to invest in currently, what is the risk to invest, what is the terms of the investment, and what are you going to expect back as a return on your investment. So real estate in general can be looked at as an investment standpoint, and that's what we do in property management. We use the income approach to determine how much we're going to pay for a particular item if it's from an investor viewed property only. If it's your personal one, then there's a lot more factors you have to think about. If you're looking at it as an investor, then you should definitely look at it as what are you going to pay and what do you hope to get on your return. So there are two types of investments. The first one would be a debt investment, and that is when somebody lends money for an exchange or an interest in something or an interest rate return in a business or a company or a real estate investment fund. So you're basically investing your money and hoping to get a debt investment that provides some kind of a return. Ownership investment, on the other hand, when you own real property, you are investing your money to get an asset. So you personally own that asset, and you're hoping to get a return on that asset. So I hope you recognize the difference between the two, the debt investment and the ownership investment. Debt investment, you do not own. You don't have any current interest in the day-to-day policies of the way they do business unless you have a large share of their stocks. Otherwise, you just basically are a silent investor or an ownership investor where you do have the complete control and asset of that asset and the management of it. When you look at those two, I hope that you realize that the debt investment, you are going to get some kind of income for that particular period, and then at the end of your term. Now, from an ownership period, you get the income during the period of ownership as well as the return on your investment in the form of appreciation. And within that appreciation, you have the benefit of determining when you sell that asset to get the return on that investment, how much you sell that property for. So during that period of ownership, you get that investment return in the form of rents, and then when you eventually sell the asset, you get your return of the investment by selling that property in the form of appreciation, and hopefully it does appreciate. When we talk about investments, we also need to look at three things. The safety of it. How safe is your investment? Is it liquid? Can you turn it into cash quickly? Can you sell it and turn it into cash if need be, if you need that cash? And the yield. What is the return you can get on that? What do you anticipate on getting back on your investment? How much are you currently expecting as a percentage return if you invest $600,000 today? We always say at work, in the assessor's office, that it's really good to diversify. If you put all your eggs in that $600,000 investment and you're hoping to get a return on just that one investment, what happens if the real estate market tanks? What happens if Qualcomm and General Atomics pull out of San Diego entirely? What's going to happen to the population? What is happening now with the population as far as purchasing? Is the general population into purchasing, or are they into renting? That's a good question, right? So it's always good to diversify your portfolio. We think of it as like a three-legged stool, right? You have a three-legged stool, and each of those legs are holding you up right there. Those legs are supporting you financially. Each of these investment types are some source of income that leads directly to you, that should be your type of investment that goes directly to your pocket. So whether that be stocks and bonds as your personal investment, whether that be real estate as far as property management and getting those rental return incomes, whether it be your government pension, whether it be Social Security, whether it be income from a spouse or from a pension plan or from current job working as your normal 9-to-5 position goes. You should always diversify your portfolio and not invest everything you have into one asset. That's not a good investment. It's not sound investment advice. So the advantages of real estate would definitely be the cash flow that you get in the form of rents and the appreciation when you sell the property with the equity. And the equity would be the value that you have received due to the fact that the value of the property is what you paid for it and the appreciation. So the money that has the liens against it that you still owe plus the appreciation, that'll give you your total equity. You have a wonderful opportunity here if you do get into property management in the form of leverage. So the more assets you own as a property manager, the better leverage you have to diversify or increase your portfolio. And you would do that by basically leveraging one property against the other. If you needed to, loan to value, loan out more on one property versus the other in order to get more assets in your portfolio. The disadvantages, however, to real estate is also the same thing that's an advantage, the liquidity. It's sometimes difficult to turn an investment such as a large single-family home into cash immediately. It could also be risky. It's a large investment if you're looking at a large purchase. It's a lot of money to dish out of pocket immediately. So what do you have to do to determine whether or not it's a good investment? How much should you buy this property for? So what you have to do is you have to do an income approach. And what that is, an appraisal, is basically determining the value of a property based on the income stream it provides you. And that's a very simplistic formula that's in your book. In fact, it's on page, let's see here. I'll get there eventually. I hope I'm in the right chapter. Chapter 2. Where are you? Here we go. Sorry. Page 27. Determining how much to pay for a property. So this is using a NOI, and you divide it by your cap rate in order to get a value. So what is NOI? NOI is your net operating income. So that means all the income that you receive after rents, after you take all the rents, all the money you receive from laundry services, from parking services, from storage services if you have an apartment complex, all the money you receive in the form of vending machines or any other source from lost deposits, differences between the applications or property management forfeiting a percentage, all that income that you get on an annual basis. Then you subtract all the expenses a property has, the cost to operate that, general maintenance, electricity, utilities, water, gardening, replacement, repairs. All of that has to be taken out of the cash flow you've generated for that year from your gross income to get your net operating income. So once you have your net operating income for the year, you then divide that by your cap rate. And your cap rate is the rate that you anticipate on receiving on this investment. So your rate of return on your investment should be determined when you purchase this property. So you have to look at what the S&P, what the Dow, what are properties in the area generally receiving on a return for their investment, whether it be an 8-unit apartment complex, whether it be a single-story office building with 24 rentable lease spaces. What are the general returns for this type of investment in the market? Normal cap rates now for specific pieces of property, whether it be residentially owned right now, are between, it could go as low as 2% on your investment all the way up to 10%. In the past few years, it has been as high as 15%. Unfortunately, we don't have that gap right now where we get a larger return on our investment. So normal cap rates right now are between 8 to 10% on an investment if it's a larger investment. If it's a smaller single family, one apartment unit, then you're probably going to get a smaller return on your investment. It's just not going to receive a higher dividend than what a property manager would get from a larger complex. So you take your net operating income, you divide that by your capitalization rate, and that'll give you the value that you should pay for this property. Once you have determined the value for this property, that is the market value for the property, will your rental income cover your debt ratio, how much you have on the mortgage, or how much you owe on that property in order to get that 8 to 10% cap rate back into your pocket? So after you take into account all those expenses, after you've paid off everybody and paid off your mortgage, will you still generate that 8% profit into your pocket? That's what's becoming more and more difficult for us property managers, is getting that rate of return that we anticipate on our investment. This is kind of a difficult subject for a lot of people, so I'm more than happy to go over it in class. If the example in your book is pretty difficult to understand, but feel free to stop by on Mondays from 6:30 to 7:30 in room E-229. I hope that everybody is is going pretty smooth this week. I haven't heard very much back, but please feel free to email me or to come into class. Please complete the quiz by Sunday at 11:59 p.m. and the essay questions having to do with this property here that we're sitting in. Thanks so much. We'll talk to you soon. Bye-bye.